Last week's close put the S&P 500 at 7,500.58. That is just 1.4% below the all-time record, locking in an 11th winning week out of the last 12. And frankly, the market did this while the macro data was practically screaming at us.
Yeah, it's wild. I mean, it is Sunday morning. You are prepping your screens for tomorrow morning's bell, and the deck is completely reshuffled after that Juneteenth holiday on Friday.
Right. So we are using this deep dive to look at the massive tug-of-war ripping through the tape right now. We've got the institutional strategy briefs, the technical damage reports, the macro calendars. No fluff today. We are decoding what the largest institutions are quietly doing in the background.
Because if you're zooming out to the weekly time frame, the surface-level price action is heavily masking a massive collision. Analysts are calling it the peace dividend versus the Fed's hammer.
Yeah. Let's break down that physical supply side first. The peace dividend. We had the historic U.S. Iran ceasefire framework signed in Geneva this week.
Right, which completely reopens the Strait of Hormuz for global shipping. And the reaction in the commodities pit was immediate. I mean, Brent crude oil just cratered, down nearly 9% on the week.
From those $95 late April highs straight down to the $76 to $80 range.
Exactly. And for anyone trading equities, you know that cheaper energy acts as a massive organic margin booster. It is a deflationary shockwave through the entire supply chain.
It costs less to mine, less to manufacture, less to ship.
Right. It's essentially a giant, invisible tax cut for the global economy, pure margin expansion universally. So that is the tailwind. But the real risk here is Chair Kevin Warsh.
Enter the Fed's hammer. The FOMC held their policy meeting, and Warsh paused the benchmark at 3.50% to 3.75%, which on paper sounds benign.
Benign until you look at the dot plot. It was incredibly hawkish. You have 9 out of the 12 Fed members officially projecting another rate hike later in 2026.
They're absolutely terrified of an inflation rebound.
Yeah, they are threatening to crush it with borrowing costs. But this is where the divergence gets fascinating. Normally, a hawkish Fed threat is a death sentence for a rally. You'd see investors dump equities and rotate into bonds.
Right, but looking at the tape, the 10-year Treasury yield basically flatlined. It held steady at 4.46%. So why didn't the bond market panic?
Because of the timing of that oil crash. The plummeting energy prices from the Middle East ceasefire cooled near-term inflation expectations just enough to neutralize Warsh's threat.
The bond market is looking at $76 oil and calling his bluff.
Exactly. Bond traders are saying, look at physical commodities. Inflation is dropping organically. You won't actually have the cover to hike rates. So the 10-year yield is just coiled incredibly tight right now on its ascending trend line.
So if the broader tape is locked in this stalemate between $76 oil and the Fed's threats, we have to talk about what happened with the tech sector on Thursday.
Oh yeah, the Nasdaq 100 ripped.
Surged nearly 2.5%, tearing right back up to recapture that 30,000 level. And the microcatalyst was Intel.
Right. Intel announces a massive multi-year partnership to manufacture chips domestically for Apple. Intel shares surged 10.6% on the headline,
which sparked a violent short squeeze across the entire semiconductor space. We all know the mechanics of a squeeze, but the velocity here was wild. Funds were aggressively off sides, the headline hits, and the margin clerks step in to force the covers.
Yeah, the feedback loop was immediate. But, and this is critical for anyone modeling tomorrow's open, you cannot mistake that volume for organic, high-conviction institutional accumulation.
Because of the rebalancing.
Exactly. The massive explosion in volume on Thursday was largely an illusion. Because Friday was a U.S. market holiday, the Nasdaq 100 quarterly rebalancing had to be executed on Thursday's close.
We are talking about $800 billion in passive capital forced to execute block trades.
Right. It's purely mathematical. The passive funds do not care about the Intel news. They don't care about Warsh. They are completely price agnostic. They just have to mathematically match the new weightings of the index.
So Thursday was heavily distorted by forced mechanical buying, which means resetting the deck for tomorrow morning is going to be incredibly tricky, especially looking at this week's red folder events.
It is an absolute minefield of economic data. This week is going to brutally answer the questions left hanging by the current stalemate.
Let's run through the calendar. Tuesday, S&P Global U.S. Prelim PMIs. The street is tracking that 50 level closely.
Yeah, anything over 55 and the rate cut narrative is officially dead. It proved the economy is running too hot and Warsh is fully justified to hike.
But a cool print under 50 brings all the hard landing fears right back.
It's a precarious tightrope. Which brings us to Wednesday. The Fed's 2026 bank stress tests.
32 major banks being evaluated against a severe shock. And the parameters this year are brutal. They are modeling 10% unemployment and a 39% plunge in commercial real estate values.
Which is not just regulatory theater. The financial consequences for the XLF are immediate.
Right, if they pass, they get the green light to unleash billions in share buybacks.
Exactly. A clean pass sparks a massive rally in the financial sector. But if they fail or show sloppy capital buffers against that 39% CRE drop,
Buybacks get frozen.
frozen immediately, and the regional banks exposed to those commercial property loans will get absolutely crushed.
And right in the middle of that Wednesday macro data, we get Micron earnings.
The ultimate litmus test for the AI capex boom.
Yeah, everyone wants to know if the hyperscalers are still spending billions on hardware. If Micron guides down, that entire Thursday tech rally we just talked about could completely unwind.
True. But Thursday morning is the main macro event, 8:30 a.m. Eastern, the May core PCE Price Index.
The Fed's preferred gauge because it tracks the actual substitution effect on the ground, unlike CPI.
Right. And the expectation is an acceleration to 0.3% month over month.
If that prints hot, say 0.4% or higher, Warsh is entirely vindicated, yields will spike.
And if that happens, the sector you have to watch closest is real estate. The XLRE ETF is the ultimate proxy for interest rates here.
Okay, so knowing this massive wave of data is coming, let's look at how the smart money is actually positioning.
Yeah.
We have the preliminary CFTC Commitment of Traders report, and the divergence is staggering.
It's wild. Speculators' leveraged money are heavily shorting the market. Net short, negative 205.6 thousand S&P 500 contracts.
Which puts them in the 12th percentile of historical positioning.
Yeah, out of all recorded history, they've only been this bearish 12% of the time. They are terrified of the Fed's dot plot and aggressively hedging.
While asset managers are sitting on the opposite side of the boat, long in the 79th percentile.
Right. And if you look at the technical health of the tape, the speculators are fighting the underlying mechanics. The market is not technically overbought.
The S&P 500 RSI is sitting at a very healthy 53.
Exactly. It's digested the recent gains without losing its structural trend. And market breadth is actually improving. 56% of stocks are now trading above their 50-day moving averages.
It's broadening out beyond just the mega cap tech names. So the speculators have stretched this rubber band of bearish bets as far as it will go. They are betting on the Fed's hammer, completely ignoring the peace dividend tailwind.
Which means the pain trade is squarely higher.
The bears are utterly trapped if the data comes in cool.
We have a very clear line in the sand pivot at 7,265 on the S&P. As long as we hold above that, the structural bulls are in control.
And if we break through the immediate resistance at 7,550,
all of those heavily short speculators are deeply offsides. Dealers will be forced to buy futures to delta hedge. Speculators face margin calls.
A violent short squeeze mechanic applied to the entire S&P 500.
Right. It could rocket the index straight toward the 7,700 level.
So the game plan starting tomorrow morning is highly tactical. Watch that 7,500 level on the S&P. Manage your exposure to the overextended tech names, keeping the Thursday rebalancing distortion in mind.
And watch for structural margin expansion in the industrials and materials sectors if that 76 Stalk Oriole holds.
Exactly. But before we wrap up, I know you were looking at the bigger picture implications of that Intel-Apple deal.
Yeah, this is a puzzle that I think defines the macro environment for the next decade. We just spent this entire deep dive analyzing the tug-of-war between cheap global commodities and the Fed's hammer.
The deflationary peace dividend versus inflation fears.
Right. But look at the onshoring trend. We have a cooling geopolitical landscape offering cheap foreign energy, but simultaneously, the U.S. is aggressively building domestic, multi-billion-dollar tech foundries that operate at a massive premium compared to overseas manufacturing.
It's a completely fragmented era of global inflation.
Exactly. Cheap raw materials totally offset by incredibly expensive localized manufacturing. And if that is the new reality, you have to ask, can traditional Federal Reserve models like the PCE and these dot plots even accurately measure a bifurcated economy anymore?
That is a phenomenal point. Are the central bank's tools basically obsolete for the next cycle? Definitely something you need to be factoring into your long-term macro models. Keep your eyes on the tape tomorrow morning, watch those red folders, and manage your risk.